Credit rating agency Fitch warning it could slash ratings for dozens of lenders, saying those comments in an interview with CNBC, marking the latest sign of turmoil for the industry. Fitch initially cut its overall assessment of the banking industry back in June and cautioned another downgrade could trigger a reevaluation of more than 70 U.S. banks under its purview, including major lenders like J.P. Morgan Chase and Bank of America. Fitch's warning comes just 1 week after Moody's downgraded 10 small and mid-sized banks. Joining us now is John Heltman, American banker, Washington bureau chief. John, I've been trying to sort of put this in context this morning, right? Because Fitch did the same thing that Moody's did in saying it was these banks were on watch for possible downgrade. Nobody sort of noticed at the time, just like nobody sort of noticed when Moody's did it a few months ago. You guys at American Banker probably noticed, but the broader market didn't notice.
To be fair, there was a lot going on a couple months ago. So.
Yes, exactly. So, how seriously should we take this warning? Is it going to happen? What effect is it going to have?
Well, I'll just start here. Credit downgrades are bad. They're not good. So that is something definitely worth paying attention to. I think that there's a couple things going on here. One is, if you go back all the way to 2011, I think it was, when S&P first downgraded the U.S. sovereign debt, ratings agencies tend to kind of move together, right? Because they're looking at the same things. And so having just one ratings agency out there kind of downgrading U.S. sovereign debt for 10 years plus sort of indicated that when Moody's kind of made its move, Fitch made its move last week, what that sort of means is that if the U.S. sovereign debt isn't as good as it used to be, then things like banks that are sort of in some ways subordinate to the credit of the country they are in, those will naturally kind of have to adjust downward as well. So that's part of it. The other part of it is that banks' margins are getting squeezed in this sort of interest rate environment, right? So it now costs more to get your deposits. That's what you use to make loans. And you also have all these loans on your books that are at lower interest rates than what the prevailing rates of right now are. And of course, you have the economy sort of cooling. So loan demand is also going down, making it harder to replace your low interest bearing loans or assets with higher interest bearing assets. So all this is of a piece. And what do I make of it? I think seems like what it makes is it makes an already sort of tense lending environment just a little bit more tense, and makes the margins a little bit more thin at a time when we're also looking at maybe commercial real estate having a big drop off. That sort of, or any sort of external variable that could that could create more uncertainty in this area is just all the more dangerous.
And so from your perspective, and just trying to summarize this too, is this a result of Fed policy or more a result of bank management?
I think it's certainly the rising interest rates over the last year is the proximate cause of all of this. That's what's making banks' costs of funds go up, thus squeezing their margins and so on and so forth. But at the same time, the Fed isn't doing this to hurt banks. They're doing this to get inflation under control, which is, arguably as or more important than banks' profit margins.
And something else that you're covering, by the way, that I want to turn to is using U.S. lender or borrowers' data, I should say. And this is something that the Consumer Financial Protection Bureau is taking a look at. What do we need to know about it?
So the CFPB has said they're going to put out a proposed rule on data brokers. So the CFPB has explicitly declined to say what companies specifically would be affected by this, but it's a lot. So anyone who does data aggregation, data brokerage, think your Googles, your Amazons, but also lots and lots of fintechs are in this space using kind of consumer data and selling it for advertising, all sorts of different things. What this rule would do is sort of say that this kind of data collection of kind of credit related information can only be used for credit related purposes, not for advertising or for whatever else. And that is definitely going to affect a lot of sort of big data firms were this to be finalized.
How will this impact some of the social media companies where more transactions are taking place? There is more alternative data, perhaps, that they're able to carve out and really index and fine-tune based on interactions that take place and engagement that take place on their website. And for some of that, they're able to monetize that and ultimately turn that into not just their own method of monetizing it, but a mechanism for having a commerce-type marketplace on their platform.
So I would assume that, you know, your Metas and your Amazons have very smart people who can figure out how to, you know, say to continue to operate some level of data sharing, even under this rule. But the rule itself seems pretty chilling. It basically says you can't sell consumer data. Now, you can't sell consumer data without their consent. So maybe you could get people to consent to things, but yeah, it'd be pretty drastic. Now, the one thing that's interesting about this is that were this rule to be finalized and then for a Republican to take the White House in 2024, there's potential, and for Republicans to take the House and Senate as well, you could pass something called the Congressional Review Act that would nullify this rule. However, unlike most things that CFPB does, this actually has a lot of bipartisan support. A lot of people in Congress on both sides of the aisle are pretty sick of the way that data companies kind of buy and share personal consumer information with, in a lot of cases, without their consent.
This is really interesting. John, thanks so much for helping us break this down and reporting on this morning. American Banker Washington Bureau Chief Jonathan Heltman. Appreciate the time as always.
Thanks.